Years ago, investors are sitting on their huge pile of money looking for investment to turn money into more money. Traditionally, they went to the US Federal Reserve to buy treasury bills, believe that is the safest investment. But in September 2007, US Federal Reserve lowered the interest rate to only 1%. And it's actually pretty small return on investment. So investors said no. The financial crisis of 2007 had impact on the economy, and we were victims of economic instability, where our parents worried about jobs, savings, and so on. I have done research on the financial crisis, and the official government report called the Financial Crisis Inquiry Report was issued by the US government in 2011. So, the financial crisis of 2007 led to economic instability and led many people out of houses and work. My main points will focus on the causes of this crisis. Banks had an idea to connect investors with families or with homeowners through the mortgages. Here is how it works. A family wants the house, so they save for down payment, connect to a mortgage broker. Mortgage broker connect the family with the lender. Lender lends the money to the family buy a house and become homeowners. But one day, lender gets a call from the investment banker. This investment banker wants this mortgage from the lender. But investment banker is greedy. He wants all those mortgages for himself. Let's imagine the situation when the investment banker has all of those mortgages in one box. This box can be divided into three groups or three parts. First part is the mortgages which could be considered as the safe mortgages. Second part, mortgages which considered to be okay, and third part, risky mortgages. And according to the report, risky mortgages issued during the house bubble that many experts failed to identify. The risky mortgages were especially those who banks did not need any proof of income or down payment or no documents. And also the credit ratings agency failure or they didn't provide very accurate credit rating. And according to the SIP, the whole financial market started resembling a candy shop where everything was selling at a huge discount and without any down payment. This is the turning point. As usual, the mortgage broker connect family with the lender. Lenders lend the money. Family buy the house and become homeowners. But one day, people who were manipulated with those credit ratings, or let's say less responsible people who didn't provide any proof of income or down payment, stopped paying to the bank because they actually couldn't afford it. But it's not a big deal if one family stopped paying to the bank. Bank just take the house, and the house is owned by the bank. But over time, more and more people could not afford to pay. And additionally, according to the research by Nielsen, at some point demand decreased while supply increased, resulting in fall in prices. This led to the other problem, because people who actually could afford to pay the mortgages or those monthly payments on the mortgage, let's realize if they bought a house before this crisis, let's say worth $100,000, and now the price of the house is lower, and according to the research of the Hurt, decrease in the value of their home about 45%. It means there is no logical way to still continue to pay the monthly payments to the bank or to investment banker. So either they stop paying or they move from the house. And in that point, bank or investors or investment bankers had almost all the houses, but if they have all the houses and no cash flow from the families or homeowners to the financial institution, in that point, entire financial market froze. Official government report of the financial crisis and other sources provide a good overview to this issue. And in sum up, financial crisis was caused because of the lenders who lend the money to, let's say, less responsible people or people who didn't provide any proof of income or down payment. And also, there were many houses not owned by the families or people, but actually owned by the financial institutions or banks. The financial crisis of 2007 had impact on the entire economy, and some people even today could feel the consequences of this crisis. Welcome to financial crisis.